In the 1990 seconds, the personal computer stopped being a machine reserved for offices, universities, and hobbyists and started becoming a normal part of American life. Families brought home beige desktop PCs with bulky monitors and noisy dial-up modems. At first, these machines were often used for word processing, simple games, spreadsheets, and basic household tasks. But the truly world-changing idea was not just what one computer could do by itself, it was what happened when computers could connect to each other. Once thousands and eventually millions of computers were linked together, they could share information across enormous distances almost instantly. That network was the internet. Early on, the internet was powerful but intimidating. It was used heavily by researchers, government institutions, universities, and technical enthusiasts, but for ordinary people, it still felt confusing. You often needed to know commands, understand unfamiliar software, and have patience for slow connections. In the United States, internet use was still relatively limited in the early 1990 seconds. Then, everything changed with the arrival of the World Wide Web and, just as importantly, web browsers that made the web easy to navigate. Browsers like Mosaic, released in 1993, and later Netscape Navigator, allowed people to click links, move from page to page, and view text and images together in a simple visual format. Suddenly, the internet no longer felt like a tool only for experts. It felt approachable. That usability breakthrough set off a surge. As more people got online, businesses and investors realized they were looking at a new frontier. A physical store could only attract so many people in a town or city. A website, in theory, could be visited by anyone in the country or even the world. The scale seemed limitless. If commerce was moving online, then entirely new companies could be built around that shift. It looked like a once-in-a-generation opportunity. The internet was still young, and that made it feel wide open. If someone moved quickly enough, maybe they could become the dominant online seller of books, toys, groceries, pet food, travel, or almost anything else. That idea became the driving obsession of the dot-com era. Speed mattered more than caution. Growth mattered more than profit. The logic was simple and seductive. In digital markets, the winner could take most of the rewards. If one company became the biggest brand in a category, it might gain customer loyalty, attract more investors, and crush smaller rivals before they ever had a chance. Under that mindset, focusing on profits too early was treated almost like a weakness. If you slowed down to build a careful, sustainable business while a rival spent aggressively on advertising, discounts, and expansion, that rival might capture the market first. And if they got there first, you might disappear. So many internet companies adopted the same playbook. Spend heavily, grow fast, capture attention, worry about profits later. Investors often encourage this behavior. Venture capital poured into startups with little operating history and no earnings because the story sounded irresistible. If the internet was going to transform every industry, then even a small stake in the future number one company could produce enormous returns. Initial public offerings added fuel to the frenzy. Many firms went public while still losing money, and soaring stock prices seemed to validate the strategy. Hype became a kind of currency. A company did not necessarily need a proven business model right away. It needed momentum, brand recognition, and a convincing promise that profits would come once scale had been achieved. No company became a more famous symbol of this mentality than Pets.com. Launched in the late 1990 seconds, it rode the internet wave with brilliant marketing and unforgettable branding. Its sock puppet mascot became a pop culture phenomenon, appearing in major advertising campaigns, in the Macy's Thanksgiving Day Parade, and in a Super Bowl commercial. For a moment, the company looked like exactly what investors wanted, a fun, fast-growing, nationally recognized internet brand that seemed to be conquering its niche. But underneath the hype was a brutal business reality. Selling pet supplies online, especially bulky items like dog food and cat litter, was far harder than it looked. These products were heavy, shipping was expensive, and profit margins were thin. Warehousing, fulfillment, and customer acquisition all cost money. According to widely reported figures from the time, the company was losing money on orders because the economics simply did not work. In one famous example, the company reportedly spent more to source and ship products than it brought in from selling them. Marketing could generate attention, but attention could not repeal basic math. No matter how beloved the mascot was, no amount of buzz could change the cost of transporting low-margin, heavy goods across the country. Pets.com raised hundreds of millions of dollars during the boom, including from high-profile backers, because investors were chasing scale and visibility. Yet scale alone could not solve everything. Some internet businesses had real advantages. Software could be distributed cheaply, digital services could expand quickly, and certain categories benefited enormously from online convenience. But other products were constrained by physical reality. Pet food still had to be packed, shipped, and delivered. In the infrastructure of the late 1900 seconds and early 2000 seconds, that was expensive. The company may have been able to improve operations around the edges, but it could not magically make heavy products cheap to ship or turn negative unit economics into a durable path to profit overnight. Eventually, investors began asking a more uncomfortable question, not whether a company was growing, but whether it would ever make money. That shift in attitude was devastating. Businesses built on continuous cash infusions were especially vulnerable. If a company was losing money on every sale and depended on investor funding to keep operating, then confidence itself became a lifeline. Once confidence cracked, the model could unravel with shocking speed. That is exactly what happened to Pets.com. The company went public in early 2000, but by November of the same year, it announced it would shut down. Roughly 80% of staff were laid off. Assets were liquidated. The website was closed. Even the rights to the famous sock puppet were sold. The brand had become iconic, but the business had failed. Pets.com entered history as one of the most recognizable casualties of the dot-com bubble, and it was far from alone. During the late 90 seconds, technology stocks had climbed to extraordinary valuations, especially on the NASDAQ, which was heavily weighted toward tech companies. Then the bubble burst. From its peak in March 2000, the NASDAQ composite fell dramatically, eventually losing about 3/4 of its value. Company after company collapsed as funding dried up and unrealistic expectations collided with financial reality. In just a few years, hundreds of internet firms disappeared through bankruptcy, liquidation, or distress sales. The broader economy also suffered. The United States entered a recession in 2001. Job losses mounted, especially in technology and related sectors. Trillions of dollars in market value vanished. Estimates often put the destruction of paper wealth from the crash in the range of around $5 trillion. The dot-com crash was painful, but it also revealed something important. The internet itself was not the illusion. The illusion was the belief that every company connected to the internet would automatically become valuable, and that growth without a viable business model was always enough. The web did transform commerce, media, communication, and daily life, but in the end, the same fundamental rules still mattered. Businesses had to create real value, control costs, and eventually earn profits. Hype could accelerate a company's rise, but it could not guarantee survival. In hindsight, the dot-com era was both a warning and a foundation. It exposed the dangers of speculation, yet it also built infrastructure, trained talent, and familiarized the public with online life. Some companies from that period failed spectacularly. Others, like Amazon, survived the crash and eventually proved that internet commerce could work at massive scale, though often only after years of losses, operational discipline, and relentless refinement. The lesson was not that the internet was a fad. It was that technology revolutions still have to obey economics. The future really had arrived, but not every company that rushed into it deserved to own it.